Cash is no longer trash. In fact, keeping money in a standard savings account right now means you are actively losing purchasing power every single second. While most investors are waiting for central banks to rescue them with deep interest rate cuts, the hard truth is that those cuts are officially off the table for the foreseeable future. Inflation is remaining incredibly sticky around 3 to 4%. Central banks are forcing interest rates to stay higher for much longer than anyone anticipated. This shifts the entire landscape for next week. If you are using last year's playbook, your portfolio is going to suffer. But if you know where the smart money is moving right now, this environment creates a massive generation of predictable income. What most people don't know is that higher interest rates are actually a massive hidden gift for everyday investors, provided you stop buying overvalued tech stocks. The media loves to talk about market volatility and geopolitical tension. What they are ignoring is that safe, boring assets are currently yielding their highest returns in over a decade. You do not need to take massive risks to beat inflation today. Next week, the smartest move you can make is to secure locked-in yields before the market shifts again. We need to focus on short-term US Treasury bonds, specifically the 3-month or 6-month notes. These are backed by the full faith of the government. They are currently yielding well over 4.5%. It is completely risk-free income. If you want an easier route, look at short-term Treasury ETFs like the ticker SGOV. This fund buys these exact short-term bonds for you. It pays out interest every single month like clockwork. It gives you maximum flexibility to move your cash whenever a stock market crash presents a buying opportunity. Before you skip to the end to just buy bonds, the real growth right now is hiding in global energy giants. High interest rates usually hurt companies, but there is one massive exception. This brings us straight to our second focus area for next week, which is cash-heavy global energy providers. Geopolitical tensions in the Middle East have flared up again, directly pushing oil prices back over $80 a barrel. This acts as a massive tax on the global economy, but it makes specific energy companies incredibly profitable. Look closely at Shell on the London Stock Exchange. Shell just released a massive trading update confirming their profit margins are exploding. Because they have so much extra cash, they are buying back billions of their own shares. This automatically boosts the value of the shares you own. For US exposure, ExxonMobil provides the exact same high-margin benefit. These companies are not tech startups relying on future promises. They are generating massive cash right now. They are handing that cash directly back to investors through growing dividends. If you want broad exposure without picking single stocks, the Vanguard Energy ETF, ticker VDE, bundles all these global energy powerhouses into one single fund. The surprising part comes next because the ultimate hedge against inflation isn't gold. It is European infrastructure. While the US market is heavily weighted toward expensive technology stocks, Europe is filled with highly stable, asset-heavy companies that actually perform better when inflation stays sticky. A perfect example for next week is ACS, a massive infrastructure and engineering firm listed in Spain. They specialize in building data centers, transport networks, and civil engineering projects across the globe. Why does this matter for your wallet next week? Infrastructure contracts almost always have built-in inflation clauses. When prices go up, the fees they charge their clients automatically go up too. ACS is currently projected to grow its revenue by over 8% annually, completely outpacing the broader European market. If you want a diversified way to capture this European stability, look at the iShares Stocks Europe 600 ETF. This tracks the largest 600 companies across Europe, giving you instant access to stable sectors like healthcare, financials, and infrastructure at a massive discount compared to US stock valuations. If you are finding this breakdown helpful and want to stay ahead of the markets every single day, hit that subscribe button right now. We post daily updates to make sure you never miss a critical market shift. Now, if you want true defensive stability in the UK, you have to look at the defensive value sector. The UK market has faced some pressure recently due to domestic budget concerns, causing the FTSE 100 to pull back. This pullback has created an incredible entry point for long-term investors. Consider AstraZeneca, one of the largest pharmaceutical companies in the world. Healthcare demand never drops, regardless of what the central banks do with interest rates. People always need medication. AstraZeneca has an incredibly strong pipeline of new treatments, and their global revenue stream completely insulates them from local UK economic issues. Another incredible option on the London Stock Exchange is National Grid. They operate the essential electricity and gas transmission networks. They are a literal monopoly. They are currently investing heavily in upgraded power grids to support the massive wave of artificial intelligence data centers being built across the country. This gives them guaranteed, regulated cash flows for decades. For automated diversification across the best of British industry, the iShares Core FTSE 100 ETF allows you to buy the top 100 UK companies in one click, yielding a highly attractive dividend. What most investors fail to realize is that preparing for next week is not about guessing which way the market will move tomorrow. It is about building an unbreakable structure. The amateur investor tries to time the exact bottom of a stock market dip. The professional investor allocates capital based on macroeconomic realities. Right now, the reality is higher interest rates, sticky inflation, and high energy costs. By spreading your purchases next week across short-term US Treasuries for guaranteed yield, global energy giants for immediate cash flow, and European and UK defensive giants for stable growth, you are effectively creating an all-weather portfolio. You do not need to stress over the daily news headlines because your assets are actively designed to profit from the exact conditions causing other investors to panic. Keep your portfolio simple. Focus on companies with real earnings and let the compounding interest do the heavy lifting for you. Make sure to keep a close lookout for our next video posted daily to keep your portfolio protected.